Imagine owning a business that compounds at 20% a year. Sounds like a dream, right? You'd think you're on your way to massive wealth. But in 1979, Warren Buffett issued a sobering warning. Even with those returns, you might still be getting poorer. Why? Because of inflation, taxes, and misleading accounting. These silent wealth killers can erode your gains without you even realizing it. Fast forward to 2025 and guess what? We're staring at the same storm: rising prices, distorted returns, and investors chasing illusions. But here's the good news. Buffett's 1979 letter holds timeless wisdom that can help you protect and grow your wealth, for real. Let's break it down. Buffett warned, even a 20% return can produce a negative real return under inflationary conditions. Back then, inflation was nearly 14%, and top tax brackets ate up even more of investors' returns. He coined what we now call the investor misery index, the combination of inflation and taxes. If that number exceeds your return on equity, your purchasing power shrinks, even if your portfolio seems to be growing. And this isn't just ancient history, it's still happening. Take mutual funds today that promise 12% annual returns. After taxes, that drops to around 9.6%. Factor in 5 to 6% inflation, and your real return is barely 3 to 4%. Still think you're getting ahead? Even safe dividend-paying stocks aren't immune. Look at AT&T in the US or Coal India here at home. Both offer juicy dividends around 6%, but their stock prices have stagnated over the past 5-7 years. So yes, you're getting income, but your capital isn't growing, and your purchasing power may actually be falling behind. The takeaway: in high inflation times, a good-looking nominal return means little. Always calculate your real return after taxes, after inflation, and after the hype. Buffett also opened up about one of his biggest investing regrets: buying a struggling textile company that looked like a bargain, but kept bleeding cash. His lesson? Turnarounds seldom turn. You don't get rich betting on comebacks. You get rich by owning solid businesses from the start. We've seen this play out recently with companies like WeWork, bought at rock-bottom prices after its IPO debacle, only to head straight into bankruptcy. Or Peloton, once a market darling, it plummeted from $160 to under $5, still hasn't turned. Buffett, instead, focused on businesses like See's Candies, simple, boring, but wildly profitable, or Geeko, low-cost, predictable, and consistently compounding. So what are today's equivalents? Think Coca-Cola, Nestle, or HDFC Bank, companies with strong brand loyalty, pricing power, and steady cash flows. They may not always be cheap, but they're worth every rupee. Takeaway: don't waste time trying to save sinking ships. Focus on great businesses even if they come at a fair price. Another big myth Buffett busted was earnings per share, Wall Street's favorite performance metric. He wrote, even a dormant savings account looks like a growth stock if earnings are plowed back. What matters isn't EPS, it's how efficiently capital is used. In other words, return on equity. Take Zoom after the pandemic. EPS grew, but free cash flows started declining. The growth wasn't translating into sustainable value. Now contrast that with Meta. In 2024, it cut costs, sharpened its focus, and improved margins. Result? ROE bounced back into double digits, and investors took notice. And what about Buffett's own Berkshire Hathaway? It's averaged a 20% return on equity year after year, without heavy debt or dilution. Key takeaway: forget EPS headlines. Look at how well a company turns capital into profits, and how wisely those profits are reinvested. Buffett's 1979 letter wasn't just a warning, it was a blueprint. It reminds us that real wealth comes not from chasing flashy numbers, but from owning great businesses with durable advantages, led by people who know how to allocate capital. And here in 2025, that lesson is more important than ever. We live in a world of high valuations, uncertain inflation, and creeping taxes. But if you stay focused on real returns, not just nominal ones, you can still win big over the long term. So ask yourself, are you growing your wealth in real terms? Or are you just inflating your numbers? If this helped sharpen your thinking, hit that like button and subscribe. Every week, we decode one Warren Buffett letter, bringing timeless investing lessons to today's market. Next up, 1980, Buffett on rational decision-making in irrational markets. Stay tuned and invest wisely.